Are you struggling to pay off your credit card debt? If so, you're not alone. Millions of Americans are stuck in a cycle of high-interest payments that keep them from achieving their financial goals. But did you know that credit card interest rates are rising? According to data from the Federal Reserve, the average annual percentage rate for credit card accounts that were assessed interest was 16.44% as of November 2021. And depending on your credit scores, your APR may be even higher. That means if you only make the minimum payment on your credit card balance each month, you'll end up paying more interest over time and staying in debt longer. For example, let's say you have a $5,000 balance on a card with a 24.1% APR, which is the average rate according to Forbes Advisor's weekly credit card rates report. If you only pay $100 per month, it will take you over 9 years to pay off your debt and cost you over $7,000 in interest. That's why it's important to understand how credit card interest works and how to reduce it. In this video, we'll explain how credit card interest is calculated, how it affects your monthly payments, and how long it takes to pay off your debt. We'll also share some tips on how to lower your APR, negotiate with your creditors, and find the best balance transfer offers. Don't let rising credit card interest rates keep you from reaching financial freedom. Watch this video now and learn how to take control of your debt today. To understand how credit card interest works, you need to know a few terms. APR, this stands for annual percentage rate, and it's the interest rate that applies to your credit card balance. Your APR may vary depending on your credit score, the type of transaction, and other factors. You can find your APR on your credit card statement or online account. DPR, this stands for daily periodic rate, and it's the interest rate that applies to your credit card balance each day. To get your DPR, you divide your APR by 365. Average daily balance, this is the average amount of debt you carry on your credit card during a billing cycle. To get your average daily balance, you add up your balances for each day of the cycle and divide by the number of days. Billing cycle, this is the period of time between two statements, usually about a month. Here's how credit card issuers calculate how much interest you owe. They multiply your average daily balance by your DPR to get your daily interest charge. They multiply your daily interest charge by the number of days in your billing cycle to get your monthly interest charge. They add up all your monthly interest charges for different types of transactions to get your total interest charge for that cycle. Let's see an example with some numbers. Say you have a credit card with a 20% APR and a 30-day billing cycle. You start the cycle with a $1,000 balance and make no payments or purchases during that time. Here's how much interest you would pay. Your DPR is 0.055%. Your average daily balance is $1,000. Your daily interest charge is 55 cents. Your monthly interest charge is $16.50. Your total interest charge is $16.50. As you can see, carrying a balance on your credit card can cost you a lot in interest over time. That's why it's important to pay more than the minimum payment each month and try to pay off your debt as soon as possible. The best way to avoid paying interest on your credit card is to pay your balance in full every month. This way, you can take advantage of the grace period, which is the time between the end of your billing cycle and your due date. During this time, no interest accrues on your purchases. Paying your balance in full also helps you build a good credit history and score, which can save you money on other types of loans in the future. But there's another benefit to paying with cash instead of credit: you may spend less. Studies show that people tend to spend more when using a card compared to cash. This is because paying with cash feels more painful than swiping a card. When you hand over cash, you see and feel the money leaving your wallet. When you use a card, you don't get that immediate feedback. According to Shift Processing, more than half of purchases made with cash are under $10, while the average credit or debit card purchase is $112. Consumers will spend up to 83% more when using a card versus cash. So if you want to save money and avoid interest charges, consider using cash for smaller or discretionary purchases. You may find that you're less likely to splurge on things you don't really need or want. If you're carrying a balance on your credit card, you may be wondering how to lower your interest rate and save money. The good news is that there are some options you can try. Call your card issuer. Contact your credit card issuer and explain why you would like an interest rate reduction. You could start by pointing out your history with the company and mention your good credit or on-time payment history. Now is the time to mention any lower credit card rates you've been offered or found in your research. Be polite and respectful, but also firm and confident. Ask for a specific rate that you think is reasonable and fair. Compare different offers. If your card issuer won't budge on your interest rate, you may want to shop around for a better deal. You can compare different credit card offers online or use a tool like Capital One's Card Finder to see which cards you may qualify for based on your credit profile. Look for cards that offer low or 0% introductory APRs, rewards programs, no annual fees, and other perks. Consider a balance transfer. Another way to lower your interest rate is to transfer your balance from a high-interest card to a low-interest one. A balance transfer is when you move some or all of the debt you owe from one card to another, usually with a lower interest rate. This can help you save money on interest charges and pay off your debt faster. However, balance transfers are not free. You may have to pay a fee, usually 3% to 5% of the amount transferred. You also have to pay attention to the terms of the new card, such as how long the low or 0% APR lasts, what the regular APR will be after that, and whether there are any other fees or penalties. Before you do a balance transfer, make sure you read the fine print and do the math. Compare how much interest you'll pay on both cards over time and factor in any fees or charges. You can use an online calculator like this one from NerdWallet to help you decide if a balance transfer makes sense for you. If you've decided that a balance transfer is right for you, here's how to do it. Find a balance transfer card that suits your needs. You can use tools like Capital One's Card Finder or NerdWallet's Balance Transfer Calculator to compare different offers and see which one can save you the most money. Apply for the balance transfer card online or by phone. You'll need to provide some personal and financial information, such as your name, address, income, and social security number. You'll also need to provide the details of the card you want to transfer your balance from, such as the account number and the amount you want to transfer. Wait for approval. Depending on your credit score and history, you may get approved instantly or within a few days. If you're approved, you'll receive your new card in the mail along with a confirmation of your balance transfer. Start paying off your debt. Once your balance transfer is complete, you'll need to make at least the minimum payment on your new card every month. Try to pay more than the minimum if you can and pay off your debt before the introductory period ends. Otherwise, you'll start paying interest on any remaining balance at the regular April. Avoid making new purchases on your new card. Unless your card offers 0% APR on purchases as well as balance transfers, any new purchases will accrue interest right away and may reduce your available credit limit for transfers. It's best to use another card or cash for new purchases until you pay off your transferred balance. Keep an eye on both cards. Even though you've transferred your balance from one card to another, you may still receive statements from both cards until the transfer is fully processed. Make sure there are no errors or fees on either statement and pay any remaining balances or fees on your old card. By following these steps, you can successfully do a balance transfer and save money on interest charges. Credit card rewards points may seem like a great way to get free money or travel, but they also have some drawbacks that you should be aware of. They can cause you to overspend. Many credit cards offer welcome bonuses that can be worth over $500 if you meet the spending requirements. But if you overspend just to earn a bonus, you risk racking up debt and high interest charges that can counteract any rewards you earn. The same goes for credit card rewards programs that earn cash back, points or miles. If you spend more than you normally would just to earn more rewards, you may end up paying more in fees and interest than what your rewards are worth. They can be funded by people who are broke. Credit card companies make money by charging interest and fees to their customers, especially those who carry a balance or pay late. According to a study by the Federal Reserve Bank of Boston, about 65% of credit card users are revolvers, meaning they don't pay their balance in full every month and incur interest charges. These revolvers subsidize the rewards that the other 35% of users enjoy without paying any interest. They can be devalued or expire. Credit card rewards points are not guaranteed to keep their value over time. Credit card companies can change their rewards programs at any time, such as reducing the earning rate, increasing the redemption cost, or adding new fees or restrictions. Some credit card rewards points also expire after a certain period of time or if your account becomes inactive. They can complicate your taxes. Depending on how you use your credit card rewards points, you may have to report them as income on your tax return. For example, if you redeem your points for cashback or gift cards, they may be considered taxable income by the IRS. If you redeem your points for travel expenses that are related to your business or work, they may also be taxable as fringe benefits. Before you sign up for a credit card with rewards points, make sure you understand how they work and what they cost. Don't let them tempt you into spending more than you can afford or need. And always compare different offers and programs to find the best value for your money. According to the latest consumer debt data from the Federal Reserve Bank of New York, Americans have a total credit card balance of $986 billion as of the fourth quarter of 2022. This is the highest level since the New York Fed began tracking in 1999 and marks a $61 billion jump from the previous quarter. But how does this debt vary by card type and social class? Here are some statistics based on different sources by card type. According to Experian's 2022 State of Credit Report, these are the average credit card balances by card type as of Q3 2022. Retail cards, $1,888. Bank cards, $5,474. Gas cards, $1,013. Travel rewards cards, $6,040. By social class. According to the Ascent's analysis of Federal Reserve data, these are the average credit card balances by income percentile as of Q3 2022. Lowest quintile, $1,621. Second quintile, $2,585. A third quintile, $4,111. Fourth quintile, $6,036. Highest quintile, $10,175. Credit card payment statistics. According to TransUnion's Q4 Industry Insights report, these are some statistics on how Americans pay their credit cards as of Q4 2022. The percentage of credit card accounts that carry a balance is 41.8%, down from 43.7% in Q4 2021. The percentage of credit card accounts that are current is 97.5%, up from 96.8% in Q4 2021. The percentage of credit card accounts that are delinquent is 7%, down from 2% in Q4 2021. The percentage of credit card accounts that are seriously delinquent is 0.9%, down from 1% in Q4 2021. These statistics suggest that most Americans pay their credit cards on time and avoid carrying a balance or paying interest charges. However, there is still room for improvement for those who struggle with debt or miss payments. Now that you know how to lower your credit card interest rate and pay off your debt faster, here are some tips to help you avoid getting into debt in the future. Stick to a budget. A budget is a plan for how you spend and save your money each month. It helps you track your income and expenses and see where you can cut costs or increase savings. You can use an app, a spreadsheet, or a simple pen and paper to create and follow a budget. Build an emergency fund. An emergency fund is a savings account that you use only for unexpected expenses, such as car repairs, medical bills, or job loss. Having an emergency fund can help you avoid using your credit card for emergencies and getting into debt. Aim to save at least 3 to 6 months' worth of living expenses in your emergency fund. Use credit cards wisely. Credit cards can be useful tools for building credit, earning rewards, and paying for large purchases over time. But they can also lead to debt if you're not careful. To use credit cards wisely, follow these rules. Pay your balance in full every month to avoid interest charges. Don't charge more than you can afford to pay off. Don't use more than 30% of your available credit limit. Pay on time every month to avoid fees and penalties. Choose a card that suits your needs and preferences. By following these tips, you can stay out of debt and enjoy the benefits of using credit cards responsibly.